I'm John Hanna with CDTV.net in New York, and we have Greg Womack, President of Womack Investment Advisors at Edmond, Oklahoma. So, Greg, what's been happening right now? Are we kind of like on a trading range right now because it seems to be stuck at 9,000?
Yeah, the Dow is up 4.5%, year to date. As much as we've come up in the last few months, and we're still up only 4.5. However, the Nasdaq, 25% up year to date, and the S&P up 9%. So we've had such a good increase, and we've still got some reporting left for the second quarter, and so we're going to have to see some really good numbers and some really good surprises, I think, for the market to keep moving much higher. But last week, the equity markets ended a remarkable July on a high note. Sharp increases of the previous 2 weeks leveled off a bit, but the direction was still positive. And that was, key economic and housing statistics really helped. Like I said, some good news there. And the Dow saw its best months in October of 2002, and the S&P racked up its fifth straight month of gains. And the Nasdaq, of course, continued to add to its year-to-date lead over the other markets. But some good news last week, or at least better news. Nation's plunging gross domestic product, which is a measure of economic health, slowed its descent in the second quarter. The initial estimate fell at an annualized rate of 1%. Though that's still a decline, it's a big improvement from the prior month, especially considering estimates for first quarter GDP were revised to negative 6.4% instead of the earlier negative 5% it had projected. Slower declines in exports and business spending accounted for much of the improvement in the GDP. However, our personal consumption expenditures, not counting food and energy, which the Fed monitors as an inflation gauge, rose 2%. So some good news on the GDP level. We saw June sales of new homes improve, biggest monthly increase in 8 years, although it was still 21% below last year's figure. Also, good housing-related news. Many home prices in 20 major cities were up about 0.5% from April. Doesn't sound like much, John, but it's the first monthly gain in the Case-Shiller Index since July of 2006. So the index is still down about 17% from May of 2008. Auto factory shutdowns and lower defense spending caused the June orders for durable goods to fall 2.5%. That was the first decline in 3 months. However, if you take out autos and airplanes, then the actual number rose by 1.1% from May. Consumer confidence was off a little bit from the previous month. But looking ahead, John, key releases this week for some manufacturing, construction spending, auto sales. We've got personal income and spending, pending home sales, factory orders, oil inventories, and then the big one is on, of course, the 7th, Friday, is unemployment and consumer credit. So, unemployment has started, the weekly numbers have started getting a little bit better, but they're still down, and so we'll probably see the long-term trend continue a little bit higher, as an ongoing. But how far can this market go really depends on how much better news the economy is getting as far as less bad news. And of course, the rest of the earnings season's finishing up here in the next few weeks.
With all of this happening, we're kind of like on a slowdown process with the earnings. So pretty much trying to digest the earnings reports. You got analysts upgrading or downgrading a stock. With this kind of scenario, this time of the year, what would you recommend for the investors who want to invest into the market? Should they hold off? Should they try to go out to the beach somewhere and just relax and then come back in the fall?
Well, typically, the volume does drop off in the summer, and so we're seeing, typically either a trading range or sometimes you'll see initially a summer rally. I think we've seen such a big increase like I mentioned last week on chasing return, and you're hearing a lot about, the new bull market, you've got to be very careful. People who haven't been in the market now are thinking about getting back in. And if you've missed that opportunity over the last few months, you need to be very careful in your selection. I would still stay somewhat defensive, looking perhaps at consumer staples or utilities, things of that nature, because those pay very good dividends and haven't seen the huge increase like the general market some sectors have. So you want to pick out a diversified mix of stocks if you're going in, and I would suggest dollar cost averaging since we've had such a nice move up. So if you're targeting a certain stock or sector and you want to invest in 3 stocks, let's say, and you can invest at least 500 shares in each, you might do that a third now and give it some time and see if the market does correct back. Then you can invest more if those stock holdings still make sense. And then dollar cost average, because we don't know what's going to happen. And one thing you need to be, if you're going to put the money in, make sure it's money that you can be put at risk, because the markets can be very volatile. Even though we've had a nice increase, you don't want to chase return. If you look at a stock, look at a chart, make sure it's not significantly above the 200-day moving average, or in this case, if it's still below the 200-day, not significantly above the 50-day moving average. If they are, that means the stocks have made significant upticks and significant moves, and it's a natural for them to pull back at some point. So you want to be patient, do your homework, and dollar cost averaging might make good sense from here.
That's Greg Womack, President of Womack Investment Advisors at Edmond, Oklahoma, and I'm John Hanna for CTTV.net in New York.